Okay.
Perfect.
All right, Conrad, thank you for coming today. We are here, obviously, to talk about the market. We're talking about buyer reservations, what's happening with interest rates, the whole thing. One of the reasons why I wanted you here specifically is because we don't want any BS in this business.
Well, I appreciate that.
Okay, and I know you're capable of it.
Yeah. Or maybe over optimistic, right?
Yeah,
I could be. I've been thought of as over optimistic about the market.
Good. Well, that's what we like. So,
Yeah.
so we want to. So one of the reasons when we put out some questions about what people wanted to hear on the podcast, one of the things was they did want to hear it right. Like so, we know we're having some challenges with the market.
Yeah.
And then we have some agents on one side saying, "Oh, there's nothing wrong with it. Buy, sell." And we just wanted a clear picture of it from you, and that's why we're here. So we're going to start just by introducing you. I'm going to give you a quick introduction, and then you can kind of break it down on what I missed. Okay. But you are a Hamilton native.
Yeah, Hamilton, born and raised in Hamilton. Yeah,
McMaster University grad.
Yeah, excellent. Yeah,
family in real estate.
Yes, yeah, I'm an SOB, son of broker.
Son of broker.
So are you? You're son of broker
I
too.
I am. Yeah,
you're an SOB too, right?
So siblings are in it, and you grew up around the business.
Yeah, front row. I had a front row seat to real estate my whole life. Yep,
perfect. Totally. You have okay. So you're broker owner of the #1 brokerage on the Hamilton Burlington Association or real estate board. Yeah. You have 14 offices.
Yes.
Almost 11,000 agents.
11,000.
1,100 agents.
11,000. Wow. Now that's next year's plan.
Okay. Over 14 offices, almost 1,100 agents.
And a lot of great offices like this. There's much more like yourself. Like
perfect.
Offices, team offices. We must have at least another dozen team offices throughout the area. So.
Okay, great. You've been the recipient of 7 Consumer Choice Awards for your offices. You're the former chair of Affordable Housing Projects,
yes,
where you did private and public partnerships. So give us a little background of yourself that I missed.
Yeah, and I'll latch on to that. The whole thing with affordable housing has been something near and dear to my heart. I was chair of the affordable housing flagship for many years in Hamilton and fostered these relationships. And actually, we're building a 219 unit apartment building now with 20% affordable. Wow. And it's this public-private partnership that was developed. And I'm looking at doing another 4 more. So this is the first step of that. So yeah, it's a big part of what I like to do, and it's a big part of real estate. And I think the whole housing continuum is super important. So yeah, about 10 years ago, we had about 85 agents. When we grew it to 1,100, we 10x the business. And
so despite what anybody says about you, you are a good guy.
I think so overall. Some people might. And my competitors, our competitors would say not.
Okay, so 85 agents 10 years ago.
10 years ago,
When you took it over, took it over from your folks.
Yes, I did. Yes.
Okay, and then how many agents did they have then?
We had about just around that 85 mark. Okay. And then shortly afterwards, there was an acquisition. We acquired another company and then merged the 2 companies together. And we stayed at around 300 for many, many years. I think people were looking at, do you think these guys can really pull it off and what have you? So for 3 years, we just had the stagnant growth. And then over time, we started to improve tools. Look, I always feel you have to walk in the shoes of the consumer to be innovative. So a lot of our tools were consumer empowerment, along with our agent empowerment as well. But we wanted to make a better platform for consumers, because that's how consumers drive our business, right, every day. So if you make it easier for them, then it's going to be a lot easier for your agents as well. So that's something we always thought of, right?
Okay, good. And then where do you see yourself going?
Look, growth is always, it's on our radar screen, but it's strategic growth. Like we kind of, if you drop a pin down in our first office, you'll see that we kind of grew strategically. Yeah. We kind of wanted to get market share in a certain area and start that going. And then as we got market share to the level we wanted, we expanded outwards. Yeah. And that's why this Guelph here and Rockton is something that's really important to us. Yeah. Right? Yeah. I said it wrong.
Yeah, but I wasn't gonna.
Sorry, I wasn't gonna. Rockton. No, we're not right. That's a miss. Rockwood. Sorry,
I wasn't gonna call you.
No. But it's funny because my trainer's from Rockwood. A big shout out to Carly, my trainer.
Rockton's World's
yes, the
small,
fair. Yes.
Fair.
Sorry,
World,
No, but this whole
Rockton
thing.
World Fair.
Yeah, the World Fair. Sorry, and this whole thing with expansion, it's very strategic for us, and it kind of hugs our that Flamborough and it's a. It would be a very strategic move to expand in here as well. So,
well, I was just talking to Lynn, so I found it interesting that not only are you expanding in territory, but you're expanding in your price points with the Remax Luxury.
Yeah, and that's something that we failed for years. We just did not have that luxury market share. We had market share in bread and butter of the business, let's
Yep.
say, but we didn't have the luxury share. And that's when we brought Lynn on. She came with that luxury background and grew that territory. And we're doing the same thing now with commercial.
Yeah.
We found where we rank in commercial throughout the region was pretty high. We're probably in the top. Sometimes we're in the top 3
Yep.
in certain categories. Sometimes we're in the top 5. But we're the only local brokerage, other than like I said, like big companies like CB Richard Ellis and big commercial. We're in those. We're the only local brokerage that makes the top 10. So we decided, well, we've got some opportunity there, and we're going to grow it just like we did the luxury side, just same kind of strategy and things like
So
that.
it's safe to say we got the right guy here to talk about the market.
Let's talk about it. Yeah,
Okay.
I'm in it. Like
All right.
I'm in it. Yeah.
So give me some numbers, and more importantly, like, are there key trends that you're seeing being in the business versus what the regular consumer is seeing as well, right? Because the regular consumer sees what's happening on the news. The market's going to go down 10%.
Yeah.
Everything's falling.
Thanks to TD, they said that.
Yes, and I always kind of look at the news where I think, well, if they're already saying it, it's already happened or happening. But you go ahead and you tell me, like,
Yeah.
tell us about the market and tell us about what you're seeing.
I think those old traditional markets, I've been in a long time, you see that spring market, and then you see a little dip in the summer, and then
Yeah.
you get that little rise in the fall, and then Christmas. I find that those traditional markets are no longer, and the market is very compressed.
Okay.
So I think Q1 and Q2, like we saw a really slow Q1 in 2023, and then it started to build up in Q2. I find that it goes month to month. And then the summer, we had this like great little July and August, and then
Yeah.
September. There was areas in Niagara that did not have a transaction in all of September. It was
Yeah.
like, what happened? Like the tap just turned off. So I find this market compression, and people are listening to the news and reacting. I think when they found out that inflation dropped back in August, we saw that little spur of hope
Yeah.
that we were going to, because everybody's looking at inflation being tied to rates.
Mhm.
I think people are very exuberant about the rates right now. And I think my prediction is Q1. I think Bank of Canada, you'll see tail end of Q1. Bank of Canada will probably drop at 25 basis points. The economy it's feeling it. And
One of my questions. I was
yeah.
going to ask for your prediction.
yeah, no,
Okay,
and
good.
I definitely feel that. And I think long-term rates, well, we're already seeing it. I predicted about 3 months ago, long-term rates would be down a quarter point.
Yeah.
We're seeing now there's some, again, there's some companies, some banks that are offering 4.99, but it's like putting a thread in a needle
Yeah.
to qualify for that. But it's showing me that there is this momentum in terms of getting below that 5% long term, and I think we're going to see that. The bond market's down considerably. The stock market is predicting long term rates to come down, and Bank of Canada rates to come down. So yeah, all that good stuff is happening, and we'll see that kind of excitement come into our market.
So when I look at our market, we've just done our numbers. Like from you're right. So first 2 weeks in August were great, and then other than that, the tap just turned off.
Yeah.
We've seen about a 5 to 7% decrease in what's been selling, and we're seeing our days on market extend closer to 60 days on market.
Yep.
But it's like, for me, I mean, I've been selling long enough where we know not to panic, and there's always there's not just, you can't just be speculative. There's more reasons to buy than, hey, I want to get a good deal and that's it. People need to buy because they're getting married, they're upsizing, they're downsizing, they're getting a divorce, they're moving for a job. So the market does continue. So it gets to a point where, and you can correct me if I'm wrong, where yes, people hold off and hold off and hold off, but it comes a matter of time where people need a place to live, so they have to purchase, and then they keep going, and then all of a sudden, then people start to get more confidence back in the market, and now we start to see more buys. So like, if I look at Remax Escarpment over the last 2 weeks, it's up 13.9% in showings alone.
Yes, exactly. Yeah.
Okay.
Yeah, Tyler, your intuition is bang on. I think you're exactly right. The media has really created the mindset so far, and again, the Bank of Canada, part of the psychology of the Bank of Canada is that they want to curb this inflation, and they want to show people that, oh, we've got the economy and we got to pull back, and they're always saying there's going to be a rate hike, so they want to temper the economy and moderate inflation, and they've done a reasonable job. I think they've gone a little bit too far, and they could have gone a little earlier, but they're showing the results they wanted to see. But that trickles into the mindset of the consumer, and you are so right. There are so many people that have to now pull, they have to deal with it. Their household creation is growing. Okay. Yeah. Millennials are now a quarter of the population are millennials. They are the people that are household creation age.
Yeah.
They're right there. They can't live in their parents' basements forever. They are getting married. They are moving on. And their parents and their grandparents want them to own homes, so they're helping them with down payments. And Bank of Mom and Dad's been around for a long time, and I think you'll see it even much more with these millennials that start to buy, and they're doing it on their own and getting down payments. But everything else is going to happen. So people were saying, "Look, I'll wait till something happens, but my life is going to change.
Yeah.
I can't live with interest rates." So now you got to be strategic about it. A lot of people are going with variable right now, just waiting to see if the rates and ride the rate down.
And I think it's already happened.
Yes.
Right. Like people are looking for a good deal. There's a lot of good deals to be had out there.
Yeah.
But I do I guess the flip side of that too. You're right. Millennials. I think in any market, everybody's looking at what the cost is to rent versus what the cost to buy.
Yeah.
And the cost to rent right now is skyrocketing through the roof because everybody has this same mindset where they say, well, you know what, maybe I'll rent for a year, maybe I'll rent till 2 years to see what's going to happen, as opposed to buying now. You'll be very similar to what you're paying in your rent.
Yeah.
Okay. You're always a little bit more when you buy.
Yes.
Okay. Always a little bit more, but then you make the justification where, okay, for the $200, for the $300, for the $500 extra I'm spending a month, I'm owning a house, I'm building equity, I'm paying down my mortgage.
Yeah.
So I think, people are still looking at that aspect of it as well, right? Like any market.
Yeah. Well, that's why I love the millennials, because if they are paying rent, they're great buyers because they're paying high rent, right? So there's gonna be conversations this Christmas at the table at some point, asking mom and dad, listen, this, we were renting, we need some help. These are great conversations.
Yeah.
And I think that's going to really drive a lot of what's going to go on. But then there's everything else that you said, people relocating. You've got divorce, and there are people that are debt ridden and want to eliminate some of that debt and downsize. Those people are always there. And then you have investors too that they bought maybe at a higher price and they now have to hedge. So this is where look, I just wrote a blog, and it was this month, and I talked about there's about 12 different profiles of people. And I think every listing that you have, you should actually advertise towards that consumer, like profile that consumer and speak to them. So you may have an investor, right, that may have bought a little high, maybe in 2021. So there's opportunities for everybody in this market. And this is the time to kind of look at everything that you have and say, hey, who would be that profile buyer for this? Is it a downsizer? Is it a millennial?
Yeah.
And I think that your advertising and marketing should speak to them.
Okay.
And that's where it's really all about. And again, like I said, these investors that need to hedge and average cost analysis on what they've done.
So there's a lot of baby boomer money coming. Yep. Okay. Yep. And then they are willing. It is a privilege for them to be able to say, hey, use this as the down payment. They can have terms on whether or not they want to pay it back or how they want to pay it back.
Mm-hmm. Yep.
So I guess, like, going on just on that thought, what would you say to someone who says don't buy right now that the market's going to tank?
Well, the fundamentals are just not there for the market to tank.
How so?
Because again, the big I word, immigration.
Yeah.
God bless us. I don't think we built enough infrastructure for all the immigrants, but the construction costs, like the idea of bringing in more housing to drop the price is just not going to happen. Construction costs are high, land prices are stable. The people that own large tracts of land that do development, they'll just hold until the market catches up.
Yeah.
And right now there was an interesting stat that came out. The Canadian Association of Municipalities came up with a number to reach that 5.8 million households. Yeah. That we need.
So listen up, guys. This is interesting stuff.
Yeah. So that 5.8 million homes that we need to create to stabilize the market, quote unquote. Yeah. They figured out that it'll cost $600 billion of infrastructure. So the municipalities have to spend $600 billion. That's $105,000 per house. Yeah. Per unit. That could be a little unit in the sky or something on the ground. So when you're talking those kind of dollars, these municipalities just don't have it. Like, the bottleneck is going to be the infrastructure. So because the infrastructure delayed, is there enough money to do it? Again, it's going to just drive up that resale market. So whatever is existing, well, now all boats will rise with that. So those fundamentals are there. So we're not going to reach that demand. And we've already seen it too. In Toronto, 14,000 condo units out of the 28,000 that were supposed to come out this year have been put on pause. So we're seeing all that. We're seeing the.
So are you seeing a certain type of property sell better than like 2-story properties versus like a lot of the immigration that is
Yeah.
coming in right now are families.
Yeah.
So you can't have rental condos to a certain extent. We need more space. So is it detached? Is it towns? Like, are you seeing anything like
that's
that?
funny that you say that. So you see it different at different times. It's different, So right after everybody had to go back to work after the pandemic, or 3 days a week or whatever, we saw a lot of, let's say, properties that hugged like the GTA. Let's say 2 stories in Oakville, for instance.
Okay.
So what happened was people that they bought in Smithville, or they bought outside, or they bought maybe in Niagara, and then they think I got to get closer. They bought in Hamilton. They had to get closer to Toronto because now they have to do the commute 3 times a week, or maybe 4 times a week. 2 stories, they wanted more bang for their buck. And in a 2-story, you're going to get better price per square foot as a bungalow and what have you. So we saw this surge in homes and areas which just hug the GTA, and the 2 stories did really, really well. Now we're seeing so when the market starts to come back, and you see these first-time buyers entering the market, we see the townhomes now we're seeing townhomes lower priced, you get more square footage, better value. So we're starting to see that kind of come up. So each category for different reasons. And then, I just did bungalows in Niagara, and now the bungalow in Niagara got to a certain level of price because you had a lot of downsizers coming, further flight from, let's say, from the GTA. So now those prices have got to a certain level. So now that downsizer is now looking at that. They're looking at that townhouse as well. So, and that
even as an agent, okay,
yes.
you're still as an agent, I think being in tune with the market is more important now than ever. Right.
Absolutely.
If you look at numbers from June versus numbers from October, you can't take comparable sales from June and equate them to a property right now without doing some sort of
deep
discount in the percentage.
Yeah.
So and you say that about bungalows. So if all of a sudden bungalows are low last month and then they're really high this month, and I'm going to focus on the last month without taking into consideration what's actually happening in the market.
Exactly.
So I guess being educated, in any market for realtors out there.
Oh, totally, for realtors and for consumers, Tyler, your depth of knowledge. And I don't think, look, I'm excited to be in real estate probably the most of my career, and I've been almost 30 years. So I think this is the time I'm the most excited because there are so many things going on with financial markets and real estate markets and consumer uncertainty and all that stuff coming together, and it's converging with expertise. And I think it's people like yourself, Tyler, that have that kind of depth of knowledge that are going to be able to be successful going forward. It's a big shift.
He's just pumping my.
He's
trying to pump my tires right now, But I don't know. I don't know him anything.
Yeah, I know. Not at all. No, but I just think it's so important to have that kind of expertise because let's look at what you just said before. Townhouses in Hamilton got to a certain level where now the single detached, where buyers were buying 2-3 months ago, they couldn't have bought a detached. Yeah. Now that opportunity to buy a detached is there. And they don't have to buy a townhouse condo with a condo fee. Yeah. It makes total sense. There are these windows that open up in the market every day, and that's what that market compression is all about.
And keeping an eye on it, and that happens for us too. Whether it's a townhouse or a detached property, all of a sudden your townhouse get up to a certain point because they're really popular for first time guys, and then all of a sudden I'll look at a detached and say, geez. Well, if a townhouse is here, these detached are a really good deal. You guys should start jumping on those.
Yes.
So we are seeing that, right? Mm-hmm. And those little fluctuations are happening more. The more I get into what's happening with the market and interest rates compared to when I first started. Yeah. I mean, we didn't have the same fluctuations in rates. Nope. We didn't have the same going on. So it was a little bit more base. Now we're looking at it and saying, okay, this is what we have to factor in now. This is what we're factoring then. And I always say, if you can prove the price, you can sell the house. Yes. So for us, we started to have that real slowdown, and now things are starting to move. Now we have the baseline. Okay. Yep. And now we can kind of gauge everything off a few different sales, and then things will start to go.
Oh, I agree. There's no question. And just we've got this nice moment in time where there's some great opportunities that people didn't think they could enter into. And that's what's going to spur that bottleneck effect and that log jam to kind of open up.
So first time buyers should jump on.
Yeah.
Okay. Prices are down.
Yes.
Okay. What about investors? What do you say to these investors? They're not cash flow positive. Would you tell them to wait?
Well, the interesting with the investor piece, and like I said before, I think prices I think we're in that trough now. I don't think they're going down. And I've always had this philosophy: buy the most inexpensive, unit in a neighborhood. Let's say if it's a single detached or if it's a townhouse, if you get the most inexpensive in that area, in that little geographic jurisdiction, your chance of it going up are that much better. So I think investors, again, if investors are looking for capital growth, I would definitely say that philosophy. Because look, I can't speak to this market as in depth as you can, but let me talk about Hamilton Mountain, for instance. We're seeing single detached in that 700. During the peak of the market, they were over 900.
Yeah.
So think about that.
Yeah.
Just think about that for a minute. It's something that were really done up, got $1 million. So look, maybe some of that equity was a little bit artificial and it was really emotionally driven and rate driven.
Yeah.
But now that we're seeing rates, and you're going to see rates go to that more neutral level, maybe that 4.25 or something like that, 4.5.
And that's a steady growth percentage. That's
perfect.
Great.
And that's amazing. So I think at that point, it's going to be that lower price product that's going to start to see inching up really quickly, relatively quickly.
And multi-unit buildings as well, right? Like it's a fine line, because everybody talks about cash flow. Okay.
Yes.
So if you have a sixplex and the rents are from 2018, it's not cash flow positive. But if you have a sixplex and the rents are from 2022, now all of a sudden it's cash flow positive.
Absolutely.
All right. So they either, the sellers of that property may have to take a hit. They may have to get creative and maybe getting people out of that building, or they take it down until maybe the market cools off.
And I think this is a time for investors to move up too. If they have a lot of 1 unit, 2 units here and there, and then get to that 12plex or 6 unit, I think that's a great way for investors to go. I think instead of waiting, like, I'm going to wait for this single family to go up in price, I think the bigger opportunity is you have one roof, six properties under one roof beats 6 properties scattered, in my opinion, and then start to build that portfolio as well. And I think the upper end is something interesting in the upper end, because now you look at what things are selling per square foot in the upper end. You couldn't replace it with the land. Like there's going to be that strike price where there's opportunity in that upper end. So if anyone was thinking the upper end, they're going to buy a knockdown and all the costs and the delays. You know what? Some of the stock that is available in that upper end is really, really attractive.
We always look at that in our rural or our estate lots around here as well. Like you couldn't buy the lot and build the house for what people are charging to build.
Exactly.
All right. Like on a low end, $400 a square foot, on a high end, $600 in our area here. But on average, you're looking at almost $500 a square foot to build.
Absolutely. And then you got plus, right? So sometimes, there's some huge opportunity there. If you're thinking to do something like that, it's a great opportunity. And the thing is, the luxury is done, like the Uber luxury is done very, very well. Like the 10 plus, believe it or not, is done extremely well.
And those people they don't have mortgages.
And they don't really care. And we got to remember too, like 30% don't have mortgages. So 30% don't have mortgages, another 33% rent. So you're dealing with that other 30 some odd percent of people in the market, right?
So that's interesting too. So like the 33%, okay. So basically what you're saying, 33% don't have a mortgage, 33% have a mortgage, and 33% rent.
Yes.
When people are talking about the market and interest rates and people are going to lose their homes, right? 33% have mortgages. Like what percentage of, like, it would be mainly the buyers that have bought in 2020, 2021, beginning 2022. But what percentage of the 33% is that?
Yeah, and that's
right? Like how?
It's so true. Like it's not, there's going to be this double cohort, and they probably think it's going to be about 40% of the people. That's the people that took a 3-year in 2023.
40% of the 33%.
Yeah, that's right. Yeah, of the 33%. Yeah.
Okay.
So you're going to see this double cohort happening. So there was people that took a 3-year. The strategy was take a 3-year in 2026.
I can turn our cameras on.
Yeah. And then there was so you had the guys that did a 3-year mortgage, and then you have the people in 2021 that have a 5-year mortgage. So that 2026 is going to be that double cohort. So you'll see a big chunk. But I can't remember I don't have them committed to memory, the numbers, but I apologize, but I will say this, that the percentage of people that have 65% or more equity in the 33 is pretty substantial. So it's safe to say that that's probably another 30%. So think about that. 30% have 65% their loan to value, right? So they're not going to be walking away from 35 points, right?
No.
You see what I'm saying? So within that sector, that sector, there are people with a ton of equity.
Yeah.
A good third has a ton of equity, and then it's maybe like 75% equity, loan to value rather. That's probably another 30%. So we're dealing with this kind of 30% maybe that are on the fringe, maybe.
And even that, like you're right. Like you look at the increase even in our area from 2020 to 2021, it was a 25% increase.
Yes.
We had, from 2021 to 2022 was almost another 25%.
Yes. Yeah.
And even when you hit 2022, January and February went off like gangbusters here. And then as soon as March hit, the first week in March when they had the rate, right? Then all of a sudden everything kind of cranked down. But so if you look at someone that bought in 2021 had 50% equity, and let's just say it goes down another 25%, there's still equity in that house.
100%.
So I guess for me is, yes, they're going to have to sell. Yes, they may have to sell for a little bit less than what they wanted, but they'll still come out with some equity in order to buy something else.
And that is happening, and you're seeing it happen today. So people are downsizing and they're, paying off some debt.
Yeah.
And they're able to buy another property and, maybe, pay out $50,000 of debt down or whatever, get it to comfortable levels.
So the portion that may be, a little problematic would be the ones that bought later half of 2021 and then the beginning of 2022, obviously, right? Because those were, peak.
Yeah.
Right.
And actually defaults are really, really low. However, the 850, so because believe it or not, 850 is as high as CMHC goes with mortgages, like the average, right? Average, like at the higher end.
Yeah. 850
is still a fragment of, it's a percentage, not even a percent. Less than a percent is defaulting.
Okay.
But it is trending higher. So, but that's 850 and above. So if you think, what would be the average mortgages here? When I talk to Royal Bank and I think about our vast area, they're saying to me, Conrad, it's 350, 450 is the mortgage, maybe 500. Well, that 500 and below mortgages, there's no trending rate on defaults. It's very flat. It's just more pushed. Now, you have to understand it's 850 and above. So it could be $1 million, $1.2 million, whatever that is. That's the one where we're seeing a bit of a trending rate increase, but it's still a very, very small percentage.
Okay. So at
the bottom end, there's nothing happening.
So with that, right? Somebody's that we've got postcards going out. Right?
Yeah.
We're like, if your rates are getting high and you're having trouble with your mortgage, okay?
Yes.
For those guys out there, my thoughts are, if you don't wait, if your mortgage is renewed in 6 months and you can't afford it, don't wait, get your home on the market now and try to figure it out.
Yes.
But what would you say to those guys? I mean, the banks are starting to work with people now. So tell us about that. Like if there's somebody out there and they're struggling with this, their mortgage is renewing, they're struggling with the interest rate increase. What would you say to those guys?
Well, I always say control the controllable. So in this case, they've got some equity. This is a great opportunity to then speak to a realtor, find out what's going on in the market for them, and then work those numbers backwards. And then maybe they can buy something that's a little less, drop down a notch. And have more of a controllable mortgage.
Yeah.
And like you said, banks are working with them. But don't wait till the very, very end and hope for a prayer. Yeah. Okay, because I don't think we're going to see, if you're variable right now, quarter point, half a point, maybe by Q2, it's not going to be substantial. So I think it's, take charge. You control your asset. Yeah. And what you do with the asset, and then what you do with the proceeds afterwards. So this is an opportunity to say, this is what your house is worth, this is how much equity you have, and then let's go shopping and start to build up. Because if they downsize, which is really good, because that down end market's not going anywhere. Like I said, there is no trending increase in defaults in the lower end. The lower end is the one that's going to take off the most. So you know what? Sell the asset, take your equity out, and move it to a lower price product, and then watch that equity. You'll regain the equity much faster if you decide to downsize today. Okay, or I don't even like to call it downsize. Let's right size. Yeah. Let's right size today to build up more equity in the long run, because you're only going to do it at that lower end. It'll go up much higher than let's say at the upper end. So
okay, so then I guess your spring market predictions.
Well, I definitely think that lower end is going to really, really take off.
Okay.
And then it's going to push everything along.
Yeah.
It's just going to then you'll see this whole domino effect going, all the way up, because then those people that will sell that mid-priced home will then end up buying another home and stuff like that.
And if they need to sell and there's still equity in their, like, I always look at, I mean, I hear stories from my old man from the early 90s, okay? And it was like people were walking away from their homes. And around here, there's no reason to walk away if they have the equity in their house, right?
Yeah,
They sell it, but they're not selling it at a point of desperation. They're being productive. They're planning it out. You said manage your own asset.
Yep.
If you know you're not going to be able to afford it in 6 months from now, you sell it, and that can help a lot of frustrations. It can help a lot of anxieties out there. But I guess so we had a situation recently where a seller needed to sell their home. And he was at the point where he bought it late 2022. Okay. So when he saw he was going to lose money, we were at a point in deciding where his price, because it wasn't moving. Okay, we were at a point where now we've got to think about it. Do we list it significantly under value, which kind of puts a kibosh on other homes that are selling in that market if we're going to start to undercut? But what happened was he was able to negotiate an extension. Right, an 8-month extension with his bank.
Okay, cool.
Okay,
good. Yeah.
So that gave him the ability not to have to go like now he's taken a shot and he thinks springtime's going to be better. And in his price point, he is in the 600 to 800 range. So the things are moving there. So for him, it was really good because now he can take his time. Yeah. He can sell that house. He's not selling out of desperation, I guess is what I'm talking about, right?
Yeah. And again, it's when you're selling in what markets too, because if he's downsizing, if somebody said to me to put the house for sale today in a situation like that, and I know he's got some time, there's also the option of doing it now and then buying in this lower market if he or she intends to buy.
Yes.
Right. And on the other end, this is a great opportunity to move up because I believe Canada is very good with real estate in terms of your principal residence and taxes. Go and buy I always say, and I won't use it here, but buy the biggest effing unicorn you can buy. Because I think unicorn homes, unicorn properties, and you have a lot scattered throughout this region, they are going to do very, very, very
and
well.
let everybody know what you mean by unicorn.
So a unicorn, I'm talking waterfront, I'm talking a really pretty piece of land, that kind of thing, something with some sort of a natural feature or what have you, those kind of things. And again, it's
choice areas.
Choice areas, yeah.
Right?
So because this is your only time. Look, Canada that's a sacred cow when it comes to capital gains. Like the investors, unless they get to be a certain size, they're beating up on, Airbnb and all that kind of stuff that's happening in the investment side of things, right? So I think unicorn homes is really where that opportunity to hedge, with the tax, Revenue Canada, right? You can build that kind of equity. And if it's desirable and it's got a decent trajectory, you'll do very, very well. 5% or 3% on $1 million is better than 5% on $500,000.
So somebody's out there
and it's tax free.
If someone's out there looking for their unicorn home, this would be a good time to buy it.
Absolutely.
They may get a little bit off the purchase price.
Yes, they will.
Okay. And I find those too. We have a couple areas in Guelph, even in Rockwood, we have a cobblestone area, which always sells really well. Guelph's got a few places, the Old University, Exhibition Park, St. George's Park, and all those ones in any market, they still move.
They thrive. Yep.
But we're still seeing now, even if something's a good price in a good area, okay, it's still on the market 14 days, 30 days, and then maybe after 30 days it starts to get an offer where buyers are kind of looking at it, circling around, looking at it again. I think there's benefit for buyers who can afford these things to jump on those houses.
Oh, absolutely.
Right? And then jump on them. You don't have to sit and wait. If that house works for you, then do it.
Yeah, and negotiate the hell out of it.
Yeah.
You know what's interesting too? We see this
because there's, and sorry to cut you off. There's a lot of realtors out there that are really pushing that market's going down, down. You need so you can play off that as well.
Absolutely, and then that mindset trickles into everybody's. And then these people that are sitting with these homes, they want to look. If you have your house for sale today, you've got to play. You want to do something. So this is that opportunity. But what's interesting trend that we're seeing, and I speak to agents like you all the time. When the property comes off the market, they get a flood of calls from realtors saying, hey, my client's been watching this property.
Yeah.
What?
Yeah.
You know what I mean? What's going on? Did it sell or are they going to resell it? So people are circling. It's so funny that people just don't, take that advantage of saying, hey, we want to come in and have that conversation with the listing agent back and forth.
I think
don't wait till it comes off the market.
No. And going on that as well. we probably like most of my business, okay, but 75% of it is listings, okay.
Yeah.
So I'm gonna get a lot of I'm getting a lot of calls saying, have you had any offers?
Yes, you
Are they
see? Yeah.
flexible on price?
Yeah.
You know, will your seller take this? And I make a point not to negotiate verbally.
Mhm.
I can always let them know that, you know what, if you view the have you viewed it? No, great. Take a look at the property, give the property the respect it deserves,
Yes.
and then come with me an offer, and we can work together. And there's some room.
Yeah.
But what I'm seeing is a lot of agents out there, they don't want to take the time to do that. So if you guys are out there and you have an agent that's telling you not to go view a property because it's slightly higher than what it's worth, it's a huge mistake. You need to go in there and jump in, and as Conrad says, try to negotiate the hell out of it.
Yeah.
But that
because you'll be very disappointed, because when it does sell, maybe it could sell in and around your strike price or below your strike price. You're going to be pissed.
Yeah. And we had a buyer recently where we were, it was at $1,050,000, and we were going back with the agent. He told me verbally they'd take $975, and it ended up selling for $1,025,000. So $50,000 less than, or more, than what we could have got it for.
Yes.
So in my head, and that's a disappointment on our buyer as well. Yeah. But that's just a learning curve too. So in this market, we said, okay, now let's get serious and let's jump on that one that you want. So it is still happening.
Well, it's happening. It's so compressed. And everybody's needs are part of the compression. So it's not just a matter of what's going on in the financial world. There's things that are happening with people. Maybe they have a new build that's coming. It's being built and it's almost ready to take possession. Yeah. So you just don't know. It works week to week, and that's a great story, right? That's a fantastic story and a great lesson for buyers.
It's right. And I think those agents out there, like so for agents that are listening as well, go out there and show these properties, and don't be afraid to submit that offer. If it's I'm not telling you to lowball the shit out of everything, but there is market value. Okay, there's market value in any market, whether it's going down or not. But at least go there and try to negotiate with these people, because all we have right now is our time and our expertise. And if you're not going to take the time to show the property because you don't think they can get it for that value, is a huge mistake.
Oh, huge, yeah.
So I think that's kind of fueling this market as well. Like for an agent just to call, not even go through the property, it's just doing a disservice to their client.
Oh, completely, right? And the other thing we're seeing too is that the amount of showings have dropped dramatically. So we were at 12 like per sale. 12, 13. We've gone down to closer to 8, 9. That's a really interesting piece of the puzzle. So people out today, they're really shopping, right? That's what I was saying. This is the first time in a long time I've seen a Christmas where it's 8 showings per sale. They're shopping. I think it's trickled into the psyche of the buyer that there is some play here. And the trough is here, and let's take advantage of it.
No, on that, but get agents out there, get some feedback. The feedback is more important, because we're not getting 50 showings and 10 offers. We're getting 4 showings and 1 offer, right? Okay, so we've covered a lot. I guess I'm just going to end with your predictions. We've already kind of touched on it, but your predictions for 2024. But I guess as well, I just kind of want to stress to people out there that there are opportunities in this market. Okay, there are situations where maybe you don't buy in this market, so we don't need to tell everybody to buy. I mean, I think the key is to be optimistic about what we're dealing with and try to find the good in what we're seeing. But also we want to make sure that if there is an opportunity and you guys do want to buy, now is a good time. So don't let the news shy away from all that stuff, but talk to your realtor, and your realtor would be able to go through that with you and explain where the market is and what price point, and based on what your financing is. Conrad is right now, based on all his infinite wisdom and knowledge, right?
There you go, my guy.
I mean, this guy, he's great. He's a coach, he's a teacher, but one of the things he's known for around the office is numbers. And everybody appreciates, he's out, like, if you've seen him, he's got like this like trademark scarf and these glasses, and he's got his phone, and it's like, Hamilton Mountain, like, and he's giving us market updates. So that's what we're doing right now with Conrad. Conrad, give us your thoughts for 2024.
Look, I'm bullish on the people sitting on the sidelines. I think that people have sat enough on the sidelines, waited. This is the time they're really going to make that they're going to really pull the trigger on some of these things. I think household creation is growing. The millennials are, you said about the 90s, right? I've heard a few people say this is the 90s. like, no, this is the 80s. You got to remember this. Okay, so the 80s, we had 20 in 1980.
What kind of pants were you wearing in the 80s?
I was wearing diapers.
Yeah.
Let's just leave it at that. No, but in the 80s, we had 20% interest rates.
Yeah.
80, 81, 20, 20, 2021. And it lasts for about 9 months, and then it kind of cooled down and went the other way.
Yeah.
But even, like the beginning of the 80s interest rates were pretty significant. But then what happened was that 85, 86 rolled around, and it was the boomers that fueled that market, that we had this tremendous market from, let's say, it started to build in 84, 85, all the way to around 89.
Yeah.
And then the 90s. But the 90s had fundamentally different issues. HST was the GST.
Yeah.
I'm early going back.
Yeah.
1991, that was 91. Then we had a significant time in the Ontario. We had Ray Days, the NDP in Ontario. So that affected people's mindsets and what was going on there. So there was labor unrest. There was a lot of significant things that happened. But what happened was the boomers fueled those sales, like 80, 86, 87, 80, they fueled the sales. So because they were in their household creation days, once they stopped, then the market pulled back. Yeah. So you had this huge, huge buying thing. I think we're going to see that millennials are the biggest buying group in history. They're even bigger than the boomers. Yeah. So you're going to see them, and it's going to stretch, and it's going to carry us through the rest of this decade. Yeah. For sure. Fact. Done.
And do you think there's any truth to the fact? I mean, if you listen to the news, millennials, they can't afford a house, and I mean, a lot of that, there's a little drama in there as well. But like, we're still selling to millennials.
Yeah, and they're working and they're paying high rent, and if they go to their parents at Christmas time and they tell them that, my God, my rent's is high, it really makes a lot of sense to buy, and I need a little bit of help. And there's so many things you can, speak to lawyers about agreements. You can, the parents can own 1%. They can invest in the kids' RSPs. They can collapse it in 90 days. You know what I'm saying? Like it's pretty. There's some tools in the toolbox out there, right? So yeah, this is that opportunity. And look, and the more properties that their parents and grandparents own, they're more apt to buy property as well. Yeah. So they'll
follow suit.
They will follow suit, and that's a coming. And we're seeing people that say, hey, look, they'll take possession in 2025. They feel interest rates by 2025 could be down as much as 200 basis points. Yeah. So there's some huge optimism on behalf of consumers, and they're actually buying. So we're seeing a few things happening here in terms of pockets around surrounding this area as well, and new. Okay. So that says a lot to me. When we see confidence in new, and new is way up here. So resale there's still a big divide. Yeah. The minute that starts to gain traction, then you'll see even more activity in the moderate price level in the resale market as well.
Okay, good. Mm-hmm. All right, Conrad, thank you very much.
My pleasure, man. It's awesome.
I hope everybody else enjoyed, guys, and we'll see you next time.